Hey guys, welcome back. This is Cecil Comstock, staff accountant for Texas Roadhouse, and my friend Amanda Jarvis couldn't be with us today, but she's hoping to be able to record some videos in the future for us. One of the things that we're going to talk about today, just spend a little bit of time, hopefully it'll keep you from having to do some extra reading in your textbook, and that is we're going to talk about financial statements. And one of the things that you need to grasp to be able to understand the financial statements to some degree is you've got to know that accounting equation. We talked about it last week. You've hopefully read about it a little bit, but the accounting equation is really the nuts and bolts behind accounting, and that is assets equals liabilities plus owner's equity. And we'll talk about that a little bit more in just a moment, but don't forget that accounting equation. Make sure you write that down. Assets equals liabilities plus owner's equity. Now, there are 5 major financial statements in the accounting realm, especially when they're being audited, a company's being audited. But we're going to talk about 3 of those financial statements in this brief little video. The first one is our balance sheet. A balance sheet basically tells us what is the worth of a company. For example, assets equals whatever you own, O-W-N. Assets equals whatever the company owns. Liabilities equals whatever you owe, O-W-E, whatever you owe. And then equity or owner's equity equals whatever the difference is. So if you have X number of dollars in assets and X number of dollars in liabilities, an algebraic equation would say assets equals liabilities plus owner's equity. You have the 2 given numbers for assets and liabilities. Whatever the difference is made up in owner's equity. Let me give you an example. Let's say that I buy a house and the house is $100,000. Well, that's the cost of the house, the asset, that's on one side of my balance sheet. But it's only been 2 years and I've owned the house and I've made $20,000 worth of payments. So I still owe $80,000. Well, if assets equals what I own, it's the house, $100,000. Liabilities equals what I owe. How much did I pay? $20,000. So I owe $80,000. The liability is $80,000. So what is my equity? Well, $100,000 in the equation equals $20,000 plus X. X equals $80,000. That's the accounting equation. It always has to balance. No ifs, ands, or buts. It can never go out of balance. So that's a very simple format of a balance sheet. And again, a balance sheet's purpose is to tell us what a company's worth is. That's important because the whole purpose of financial statement reporting is to help outside and inside people be able to make informed decisions about how they can or what they should do with a company. So for example, management wants to see the financial statements so that they can make internal decisions about how they can make the company run more effective and more efficiently. Outside people like investors, people that creditors who want to loan the money to the company, they want to see financial statements so they can make an informed decision about, do I want to loan this company money? Do I want to invest in this company? And if so, how much? So it lets internal and external people make informed decisions about the company. That's the purpose, the general purpose behind financial statements. Now, to the most popular statement that we talk about. It's the income statement. Why is it so popular? It's because it's the one where we actually see parts moving throughout the statement. So for example, revenue. It's the first thing that shows up on an income statement. Sales, revenue. Now there's multiple types of sales. You can have product like Texas Roadhouse sells steak, that's a product. Or you could have service like a person who comes and cleans your gutters. That's a service, but it's still sales. It could be perhaps you have a babysitting job, or maybe you've got a grass cutting gig. Those things are sales or revenue. It's just a service industry versus a product industry, industry that has inventory. So that's That's the first thing. The second thing that shows up on an income statement is the cost of goods sold. And typically you're only going to see that on an inventory or product-based company. And what is the cost of goods sold? Well, it's expenses that it takes to sell the product that is your normal selling product. So for example, for Texas Roadhouse, we season our steaks with a special blended seasoning that Texas Roadhouse invented. That seasoning, the cost of that seasoning is a cost of goods sold because it helps us sell the steaks. People like the flavor of our steaks, they like the flavor of our ribs, and because of that seasoning, it helps us sell those. So that's a cost of goods sold. You subtract those two things. You take your sales and subtract the cost of goods sold from it, and you get gross profit. It's the profit that the product itself made. But the problem is, or the challenge is, that you've got other expenses besides just those that help you sell the product. For example, you have utility expenses, gas, electric, water, telephone, cable, garbage. Those are all types of expenses that you're going to pay those no matter how much steak you sell. You still got to pay those utilities. You may have other expenses like depreciation expense, advertising expense. You might have office supplies expense. There are a lot of different expenses, and you're going to have those expenses regardless of how many steaks you sell. Now, on the other hand, the seasoning, the cost of goods sold, that's directly related to how many steaks you sell, how many ribs you sell, how many orders of fries you sell. But everything else, you're going to pay those regardless of how many steaks you sell. Those are just called general operating expenses. So, let's say that Texas Roadhouse last month in a particular store sold $100,000 worth of revenue. And then let's say they had $10,000 worth of cost of goods sold. Well, what's that give us? It gives us a gross profit of $90,000. Well, let's say then our total expenses for things like utilities and depreciation, things like, let's say that came to $60,000. So we've got $90,000 gross profit. We've got $60,000 worth of expenses. What does that give us as a bottom line? Well, it gives us 60 minus 90 is 30. So we have $30,000 of net income before income taxes. Now I know that part made you frown a little bit. We got to pay taxes? Unfortunately, yes, you have to pay income taxes. Now it's a little different for everybody, but what we usually do in the textbooks at least is we see a flat rate. So usually the textbook will say, and your income tax rate is 30% or 35%. So in this case, we're going to use just, we'll use 30%. So we decided that our net income before taxes was $30,000, and we've got a income tax rate of 30%. Well, how much is that going to be? You multiply that 30% times 30,000 and you come up with $9,000. That's our income tax for this month. So now you've got your net income before income taxes, you have your income tax. It only makes sense that since you've got to pay that income tax to the government, you have to subtract that from your $30,000. That leaves us with $21,000 of net income after our income taxes, and that's the amount of money that our store made in this example for that month. That's an income statement. It tells us how much money a company made or lost in a given period of time. Now, there's a third statement that we typically talk about, and it's a statement of cash flows. The simple definition of a statement of cash flows is it tells us how the company handled their cash in a period. So for example, there are things that we do in a company in a month that have nothing to do with cash. So for example, let's say I order some office supplies from Office Depot. I don't pay cash, I order them and I put them on our Office Depot account. At the end of a month, they're going to send me a bill and tell me how much I owe. But I've already got those office supplies. They are expenses to my company already. I just haven't paid the cash. So what a statement of cash flow does, it says, okay, we're going to say that you can't, for this statement, you can't treat those expenses as a reduction of cash because you haven't paid for them yet. So we're going to subtract those. We're going to back those out. Now, it's not important at this point to learn whether you're going to add or subtract something. It's important to understand the purpose of the cash flow statement. Anything that happens in your company with cash, that's going to be reported on your cash flow statement. If it didn't take cash to make that transaction, it's either going to be added or subtracted back to the cash flow statement so that we see exactly what happened with our cash. Why is that important? If I'm a manager, if I'm an investor, if I'm a creditor, I want to see how a company handles its cash to know whether they if they've asked me to loan them money, if they've asked me to invest in them. I want to see what are they doing with the cash they have now, how are they handling it, and that will help me make an informed decision about what I will do with loaning or investing into the company. Now that's all the information that I have for you today based on the criteria that Mrs. Comstock gave me. I hope it's helpful to you, not only for your grade, but I hope it's helpful to you going forward in whatever career you choose. Take it easy, and maybe I'll see you next time.